Welcome back to Stocks and Trades channel. We provide easy to digest information in short videos about stock market investing, personal finance, money saving, and building wealth. Our content is designed to help you achieve financial freedom sooner. Today's video will provide news, insight, and investment suggestions on the week ahead. We'll analyze 2+1 stocks to watch this week and some others that will be volatile. So, let's begin. Disclaimer. All trading involves risk. Only risk capital you are prepared to lose. Past performance is not an indication of future results. This content is for educational or entertainment purposes only and is not investment advice. Stocks fell for the third week in a row, with major U.S. indexes posting their sharpest weekly decline since March 2020, early in the pandemic. The Nasdaq dropped nearly 8%, the S&P 500 fell almost 6%, and the Dow gave up nearly 5% as investors worried about everything from rising interest rates to geopolitical conflict in Ukraine. Underperformance by technology stocks weighed heavily again on the Nasdaq, as the index on Wednesday fell into a correction. The sell-off continued the next 2 days and, at Friday's close, the index was more than 14% below a record high that it achieved in mid-November. A measure of investors' expectations of short-term U.S. stock market volatility surged more than 50% for the week, and on Friday it reached the highest level since spiking in early December following the emergence of the Omicron variant of COVID-19. Although Wall Street analysts continue to expect that companies in the S&P 500 will report a nearly 22% increase in earnings compared with the prior year's fourth quarter, some subpar results on Friday from a handful of key companies didn't provide much of a positive catalyst for stocks. Earnings season enters its busiest period during the trading week that begins on Monday. Our first stock type is dividend earning stocks. These are a great way to earn passive income. This week's suggestion is Enterprise Products Partners, with ticker symbol EPD. Enterprise Products Partners is a master limited partnership that transports and processes natural gas liquids, crude oil, refined products, and petrochemicals. It is one of the largest midstream companies, with operations servicing most producing regions in the lower 48 states. Enterprise is particularly dominant in the NGL market and is one of the few MLPs that provide midstream services across the full hydrocarbon value chain. Enterprise Products Partners has grown significantly since its IPO in July 1998, increasing its asset base from $715 million to $64 billion at December 31, 2020. This phenomenal growth is a result of expansions from organic growth opportunities, as well as acquisitions. The current portfolio of assets includes 50,000 miles of pipelines, 260 million barrels of NGL. Refined products and crude oil storage capacity, 14 billion cubic feet of natural gas storage capacity, 22 natural gas processing plants as well as 23 NGL and propylene fractionators. The company was founded in 1968 and is headquartered in Houston, Texas. W. Randall Fowler serves as the Director, Co-Chief Executive Officer and Chief Financial Officer, and A.J. Teague as the Director and Co-Chief Executive Officer. Some technical analysis data shows that Enterprise Products Partners' return on equity is 15.9%, its average volume is about 7.16 million, its market cap is $51.93 billion, its beta is 1.32, its PE ratio is 13.3, its PEG ratio is 17.74. And its EPS is $1.79. Our rating is 10 and we consider this stock as a strong buy. Based on experienced analysts offering 12-month price targets for Enterprise Products Partners in the last 3 months, the average price target is $28.63, with a high estimate of $32 and a low estimate of $24. With current price at $23.80, this would mean about 20.3% average profit over the next year. Enterprise Products Partners pays an annual dividend of $1.82, which amounts to a dividend yield of 7.63% and a dividend growth of 1.12%. The ex-dividend date is the 28th of January, so buying an Enterprise Products Partners stock by then will pay you 47 cents on 11th February. One of the things Enterprise Products Partners is known for is its steady year-after-year increase in its dividend rate. In fact, it just announced it would raise its dividend again by 3%. Enterprise Products Partners has a long history of conservative management and steady dividend increases. Disciplined capital management has kept debt low relative to other pipelines, and inside ownership is over 36%, so management interests are aligned with shareholders. So, if you are mainly interested in safe, secure, increasing dividends, then Enterprise Products Partners is a great choice. Its long historical record of not only paying dividends but increasing them every year is indeed a rare find. The above analysis is not exhaustive and just presents you some important insights. We suggest using this analysis and carry out your own detailed research before taking a decision to open any position. Our second stock type is growth stocks. A growth stock is a share in a business that's shown above average earnings and has the potential to grow faster than the overall economy. This week's suggestion is Guardant Health, with ticker symbol GH. Guardant Health Incorporated is a precision oncology company, which engages in provision of precision oncology testing and development services. It focuses on performing blood tests, vast data sets, and advanced analytics to conquer cancer. The company offers Guardant 360, a blood-based test for treatment selection in advanced stage cancer, and Guardant Omni, a broader gene panel for immuno-oncology research. The company's pipeline includes Guardant Reveal, for cancer recurrence detection in survivors, and Lunar 2, a liquid biopsy for early detection of cancer in higher-risk individuals, with an initial focus on colorectal cancer. Additionally, Guardant offers research development services. The United States accounts for 90% of total revenue, and other markets the remaining 10%. The company was founded in 2012 and is headquartered in Redwood City, California. Amir Ali Talasas serves as the president, co-chief executive officer and director, and Helmi El-Touki as the chairman and chief executive officer. Some technical analysis data shows that Guardant Health's return on equity is -44.9%, its average volume is about 1.13 million, its market cap is $7.13 billion, its beta is 0.45, its PE ratio is -17.3, its EPS is -$4.05, and its asset growth is 76.33%. Our rating is 9 and we consider this stock as a strong buy. Based on experienced analysts offering 12-month price targets for Guardant Health in the last 3 months, the average price target is $173.75, with a high estimate of $185 and a low estimate of $160. With current price at $70.10, this would mean a 147.86% average profit over the next year. Guardant Health currently has a Zacks rank number 2, which means it is in the top 20% of more than the 4,000 stocks that they rank based on trends in earnings estimate revisions and EPS surprises. The above analysis is not exhaustive and just presents you some important insights. We suggest using this analysis and carry out your own detailed research before taking a decision to open any position. Our third stock type is blue chip stocks. These are typically large, well-established and financially sound companies that have operated for many years and that have dependable earnings, often paying dividends to investors. This week's suggestion is Nike, with ticker symbol NKE. Nike Incorporated is an American multinational corporation that is engaged in the design, development, manufacturing, and worldwide marketing and sales of footwear, apparel, equipment, accessories, and services. It is the world's largest supplier of athletic shoes and apparel and a major manufacturer of sports equipment, with revenue in excess of $37.4 billion in its fiscal year 2020. As of 2020, it employed 76,700 people worldwide. In 2020, the brand alone was valued in excess of $32 billion, making it the most valuable brand among sports businesses. Nike ranked 89th in the 2018 Fortune 500 list of the largest United States corporations by total revenue. Nike markets its products under its own brand, as well as Nike Golf, Nike Pro, Nike Plus, Air Jordan, Nike Blazers, Air Force One, Nike Dunk, Air Max, Foamposite, Nike Skateboarding, Nike CR7, and subsidiaries including Jordan Brand and Converse. In addition to manufacturing sportswear and equipment, the company operates retail stores under the Nike Town name. Nike sponsors many high-profile athletes and sports teams around the world, with the highly recognized trademarks of Just Do It and the swoosh logo. The company was founded in 1964 and is headquartered in Beaverton, Oregon. John Donahoe has been the president and chief executive officer of Nike since January 2020. Some technical analysis data shows that Nike's return on equity is 45.7%, its average volume is about 5.66 million, Its market cap is $226.05 beta, its beta is 0.92, its PE ratio is 37.52, its PEG ratio is 3.57, its EPS is $3.81, and its return on capital is 23.6%. Our rating is 10 and we consider this stock as a strong buy. Based on experienced analysts offering 12-month price targets for Nike in the last 3 months, the average price target is $187.60, with a high estimate of $202 and a low estimate of $170. With current price at $142.95, this implies a 31.23% upside potential over the next year. Nike is one of the largest suppliers of athletic shoes and apparel globally. Since it sponsors famous athletes and sports teams worldwide, it is almost synonymous with success in sports and has excellent brand recognition. Another major strength is that the Nike Incorporated brand includes many others under its umbrella, including Nike, Jordan, and Converse. Nike's second quarter of the fiscal year 2022, which ended on 30th of November 2021, had some great results. The reported revenues for the second quarter were $11.4 billion, up 1% from the previous year. It should also be noted that dividends were up 14% from the previous year and reached $437 million. Nike has proven itself to be a consistent market share leader that gives it considerable economies of scale and network advantages. As a result, the company has been a rare constant in the apparel, sports equipment, and fashion industries and is today a highly profitable global juggernaut. Furthermore, Nike has acquired a virtual sneaker and collectible startup, RTFKT. RTKFT boasts one-of-a-kind virtual products and experiences created by leveraging the latest in-game engines, non-fungible tokens, blockchain authentication and augmented reality. The move is part of the company's digital transformation plan. The buyout is expected to expand Nike's base in the metaverse, with additional digital capabilities. The above analysis is not exhaustive and just presents you some important insights. We suggest using this analysis and carry out your own detailed research before taking a decision to open any position. Next week, many companies are going to release their earnings reports, which is one of the most potentially volatile times of the year for equities, and if we are not careful enough, we could put our entire portfolio at risk. Companies may announce earnings or losses and stock prices may go up or down significantly. For this reason, we suggest that you avoid or carefully consider opening a position for the following stocks during next week, and wait to evaluate the earnings announcement before deciding to invest. IBM and Southern Copper Corporation will release earnings on Monday, 24th January. Microsoft, Johnson & Johnson, Verizon, Texas Instruments, Lockheed Martin, American Express, and General Electric will release earnings on Tuesday, 25th January. Tesla, Automatic Data Processing, Abbott Laboratories, Intel, AT&T, Boeing and General Dynamics will release their earnings on Wednesday, 26th January. Thursday, 27th January will be the most popular day of the week as Apple, MasterCard, Visa, McDonald's, SAP, Mondelez International and Altria Group among others will release their earnings on this day. Finally, Chevron, Caterpillar and Colgate-Palmolive will release earnings on Friday, 28th January. Watch these stocks' prices carefully and think twice before making any decision. Next week will not be that popular among dividend stocks, but we have some interesting options to suggest. Monday, 24th January is the ex-dividend date for Pembina Pipeline Corporation. Tuesday, 25th January is the ex-dividend date for the Clorox Company, Royal Bank of Canada and Krispy Kreme. Wednesday, 26th January is the ex-dividend date for Marsh McLennan and Lennar Corporation. Thursday, 27th January is the ex-dividend date for Masabi Trust and Pfizer. Finally, Friday, 28th January is by far the most popular day. It is the ex-dividend date for Morgan Stanley, Paychex, Enterprise Products Partners, Stag Industrial, AG&C and Ford Motor Company among others. Be sure to buy any of the above stocks before the market closing of the ex-dividend's date previous day to benefit from the dividend payment. A few initial public offerings have been arranged for next week. Credo Technology Group Holding Limited, with ticker symbol CRDO, will be listed in Nasdaq Global Select. There are 25 million shares offered at a price between $10 and $12. Credo's mission is to deliver high-speed solutions to break bandwidth barriers on every wired connection in the data infrastructure market. They provide innovative, secure, high-speed connectivity solutions that deliver improved power and cost efficiency as data rates and corresponding bandwidth requirements increase exponentially throughout the data infrastructure market. If you find this video useful, please like it, Leave your comment below, share to a friend and subscribe to our channel. See you next time.